'Twas a week of hope for the precious metals, gold therein rising low to high from 1753 to 1816, plus 3.6%, and silver per same from 21.41 to 22.69, plus 6.0%. But given gold is never really supposed to stray too far from the 1780s, let alone silver be allowed to do anything material but decline, both precious metals eked out immaterial weekly gains. Gold settled on Friday at 1,799, plus 0.7% net for the week, and silver at 22.36, plus 0.7% net. Indeed a net snoozer of a week. Even as the Swiss franc saw its linear regression trend, 21-day basis, rotate further to positive. Even as the bond's price moved to a 2-week high. Even as the S&P's money flow for the week values the index 120 points lower than tis. Even, more broadly, as the U.S. money supply since March 2020 has averaged an increase of $1 trillion every 93 trading days. Even as the Federal Reserve again alerted the world that it is preparing to raise rates, they can't be outdone by the Bank of England having just done so. Even as the European Central Bank remains hand-wringing, we're actually thinking the Fed terminates the tapering and pulls the trigger in its January 26 policy statement. Sorry folks, but we had to do it, else your stick of butter is gonna cost $10. Boom. And with respect to the latter, as you regular readers well know, the increasing of Fed funds rates was very precious metals positive during 2004 to 2006 and on balance gold positive from 2015 to 2018. Yes, even as we've all these historically very gold positive events in play, 'tis low that the precious metals continue to lay. Well, MMB, the dollar refuses to die. Duly noted there, Squire. As we've been saying, market dislocations are the in thing these days. Fundamentals have been flushed down the loo, but at least we've quantitative and technical analysis to see us through. For again we quip, even as goofball wacko as market correlations have become, prices are never wrong, they're ebbing and flowing still in play, which for the trader we hope leads the correct way. Don't dare think, else you'll sink. That of course courtesy of the Trend is Your Friend department. Either way, these are extraordinarily challenging trading days. Did you know that the EDTR, expected daily trading range, of the S&P 500 right now is 67 points? The average annual trading range of the S&P from 1993 to 1995 was 47 points per year with an average annual percentage tracing of 11%. This year the S&P is tracing a range that averages better than 5% per month. Again analogous to a snake in its death throes. And yet the precious metals remain a disappointment, save to the M-word crowd. Recall gold forecast high goes bye-bye, penned back on October 2 per nixing our 2,401 price forecast high for this year. The more likely scenario shall well be gold just sloshing around into year-end, trading during Q4 between 1668 to 1849. We'd hoped to have been wrong about that, but with just 2 weeks to run in 2021, 'tis exactly what's happened. Indeed you can see it happening, or better stated not happening, here across gold's weekly bars from a year ago to date. A snoozer indeed, be it this past week or past year, the current parabolic long trend completely bereft of price actually rising. And as an added holiday treat, hardly, here is our rarely posted, graphic for silver, unable to maintain her short-lived parabolic long trend, indeed now short. Rather, a truly tarnished treat, one has to say, her appearing none too festive. But as crooned Neil Young back in '70, don't let it bring you down. As we've array of technical hope for gold into year-end, course, fundamental hope for gold springs eternal. The following chart displays gold by the day from mid-year to date. In the graphic's lower panel is a favored technical study of the trading community, the mouthful MACD, moving average convergence divergence. Of interest is the MACD having just confirmed a crossing to positive. And whilst hindsight isn't perfect, it is a useful predictor in forming a reasonable near-term target for gold, as follows. This is gold's 13th positive MACD crossover since March 26, 2020. The average maximum price follow-through of the prior 12 positive crossovers is plus 87 points within an average signal duration of 27 trading days, essentially within 5 weeks. Thus from the confirmation price of 1,799, an average 87-point rise would put gold at 1,886, more conservatively, the median maximum price follow-through across those 12 prior occurrences is plus 57 points, which if met on this run would find gold at 1,856. So with no formidably recent structural overhead resistance plus gold's penchant to have put in positive Decembers in 4 of the past 5 years, a run up to test the denoted November 16 high of 1,880 makes some sense. Prudent cash management, as always, taking precedence. Course, the biggest positive, if you will, of the week was the aforementioned old lady of Threadneedle Street raising her benchmark interest rate by 150% from 0.1% to 0.25%. Dare the first Earl of Halifax, one Charles Montague, who in 1694 devised establishing William Patterson's 1691 proposal for creating the bow flip his wig. Meanwhile across the channel, the ECB looks to curtail its emergency asset purchases, but nonetheless is assessing other stimulus measures. No rate hike there. Certainly neither in China, as economic consumption and the property market continue to weaken. Got dollars? For indeed, as you already well know lest you've been in a hole, the stateside Fed folks look to bring their bank's funds rate up into the 0.75% to 1.00% target range by the end of next year. And as noted, we think they'll initially move on January 26, barring an excessive bout of oh my Omicron. Oh, and from the oh by the way department. President Joe Biden just signed the $2.5 trillion dollar debasement declaration so that SEC Janet Old Yeller Yellen can keep paying the nation's debt obligations and bills through most of next year. For some perspective, the U.S. money supply from January 2, 1998 to September 9, 2005 grew by $2.5 trillion, a pace of $1 trillion per 802 trading days, during which time the price of gold increased by 55%. Today, as previously noted, the money supply is increasing at an average rate of $1 trillion per just 93 trading days, but terrifically underowned gold basically ain't done squat. Technical term. Just in case you're scoring at home. Speaking of scoring, the economic barometer's strength through November has run out of puff thus far in December. Notable barrow improvements from last week's set of 15 incoming metrics include November's capacity utilization and building permits amongst other higher housing measures, but the month's growth in industrial production slowed significantly, as did retail sales. And whilst December's New York State Empire Index marginally gained ground, the Philly Fed Index more than halved what November's had found. And oh yes, there was also wholesale inflation for November, the Producer Price Index recording an annualized pace of plus 9.6%, which makes the old riddle about how many zeros can fit on a Zimbabwean dollar, not as funny as once 'twas. But 'tis not to worry, the FOMC having just stated that, progress on vaccinations and an easing of supply constraints are expected to support continued gains in economic activity and employment as well as a reduction in inflation. As to how many rising baby blue dots does a consistent trend make, let's turn to our two-panel graphic for gold's daily bars from 3 months ago to date on the left and those for silver on the right. The respective rightmost upturns from the minus 80% axis are generally harbingers of higher prices, and to wit the MACD study for gold earlier shown. But Friday's rejective price action does initially breed some cause for concern, the M-word crowd. The quadruple which? Both. Next weave the 10-day market profiles for gold and silver. To be sure, by this view gold's infinite 1780s appear supportive, whereas poor ol' sister silver's array is a congested display. Let's close with 3 mentions of inflation. Dow Jones Newswires reported this past week that a factor in determining the duration of inflation is how we feel about it, which in turn shall guide the Fed's interest rate decisions. Folks are well paid to write this stuff. Here's what we feel, be it cost push or demand pull or both, when the money supply increases 33% in less than 2 years, 'tis game over. From the same creative bunch also came the notion that because increasing inflation effectively makes for negative real rates of interest, the FOMC in not yet voting to raise rates is therefore actually stimulating the economy. Yeah, we get that, but such rationale may be the biggest infatuative policy wonk hot air crush ever. Speaking of which, here's an inflation-induced blast. We read that the rather wealthy Speaker of the U.S. House of Representatives is not supportive of a proposed ban on congressional members from owning individual equities, her stating that we're a free market economy. How's that for a 180 degrees turn? Maggie Thatcher, you don't know what you're missing. But don't you miss out in getting some gold and silver on the cheap before inevitably they leap. True, they had a rather feeble takeoff attempt this past week. But once they really get airborne, that'll be our kind of inflation, right there.